Hello everyone, just doing a sound check here. Awesome, Bo, thank you. Yeri, good hanging out on Saturday. Now just a one run a night. Yeah, we'll get going here in just about a minute. Welcome to the Kendall Report. I'm Bob Kendall. It's Sunday night. Getting a little later start than I wanted to, just looking at the last few things. So if you've been hanging around the channel for the last several days, you know that at least for Thursday night, then on Friday, live stream that I did, I was talking about the yield curve and dislocations of capital. I've been actually talking about this for a while. So this is not something that I believe is mainstream or folks are figuring out what's going on just yet. We saw a crazy collapse in Bitcoin over the weekend, all kinds of stuff. I'll talk about all these things as we get through this next probably better part of an hour by the time I get through with all this. But there's, last week was very interesting. Especially with the volatility, and volatility is going to remain high. So we're going to see probably some crazy ranges again this week. That part of the market is not over. I've been calling it the volatility monster showed up. It's not going anywhere around. And all the metrics that I use, when I go through the technicals, I'll show you exactly what I'm talking about. There's just a lot of volatility. It's not going to soften. I don't think. If we're lucky, it might take another 5 or 8 days if things stabilized, and that doesn't necessarily look like what's going on. Now, coming into this week, it's a typical week after employment numbers come out. There's not a lot of material news coming out. We do have CPI coming out on Friday, but that will be focused on closer into the week. But for right now, everybody's still reeling from the last couple of days and printing down to the 45 handle on the S&P. Actually, we printed just below it on the futures. So just a lot of things going on. So let's take a look at a couple things before I go into my normal potential little rant here. But we're looking at S&P last week down minus 0.9. It felt worse than that, didn't it? Nasdaq down 2.6. That's about right. And Russell down 3.9. We're seeing a Russell rebound about 1% in the futures right now. We'll see how that holds together. But they've really have run away too far, I think. And I'll cover, like I always cover the Russell, so we'll go through that here in just a little bit. But the big losers were the growth stocks, right? Everything from the Amazons to whatever, Microsoft, whatever, were down, anywhere from 1.5% to as much as 6%, depending on what you're looking at. So that is an interesting scenario because those have been the strongest part of the market prior to the last couple of weeks. As you know, and when I go through the details tonight, we did get a confirmation of a weekly reversal. So I'll set up that pattern as well as we go, not only tonight, but as we go through the week and see what sets up. So let's talk a little bit about what I believe is going on with the banking system, with the yield curve flattening like it is, especially in the 2-10s and I've been looking at the 13-week and the 10, and also even the 10-30 spreads are all just flattening, and that's a little scary because what that does is squeeze the margins right out of the banking system. And I know they do these stress tests all the time and tell us how wonderful things are. I saw the Secretary of Commerce coming on an interview that she did after the employment numbers came out, and of course everything's rosy. It's never been better. These are the best numbers we've seen, and the administration's doing a great job, all that stuff. And they did get bailed out, which I'll also cover on this crude oil situation. And, it looks like that's maybe going to take a while to recover. It looks like it'll stabilize, but they got bailed out on this thing totally. And with the CPI coming out this week, I don't think any of this stuff is going to get reflected in those numbers. But I think maybe because of all the drop in the things I've been talking about, the metrics that are triggering all of the inflation have all got tweaked backwards. And I think it was 2 Fridays ago that I talked about that all of the metrics that we've been watching, everything that we were anticipating, further advances for inflation, everything, the script got completely flipped 2 weeks ago. I saw a comment on the YouTube channel that somebody said, gee, 180 degrees from where I was 3 weeks ago. And I am at the moment. still don't think there's a major disaster happening here, but there is still some relative risk to deal with. Secular trends are still in place and longer term trends, but that doesn't mean there can't be another 5, maybe even 7% correction here. I'm not really calling for that, as I'm going to show you here in a little bit. I think we'll see some stability, maybe an attempt at a rebound in the next couple of days, but with who knows what kind of news they're going to come up with. They're throwing the Omnicom, I call it, around like it's real, and I know that ought to bring the trolls out a little bit. But the bottom line is there's really nothing there, and I've been talking about this, that something else is going on. There's something else triggering all this selling, especially in Bitcoin and just every asset class. Doesn't matter what it is, just sell. And did a lot of people get caught in their stock positions? Maybe so. We look at things like RK, right? Like the innovation from the famous Cathie Wood, who is down, I think, 37% from the highs this year. And she's still being taunted around as some genius because she called a few things a couple of years ago. The thing I learned a long time ago in this market, you're as good as your last trade. And her last trades aren't very good. And, so I'm not really calling her out. I'm just pointing out that those stocks, all the meme stocks, all those big high so-called growth stocks, would do air quotes, have collapsed. Most of them anywhere from 30 to 50%. I think something like 80% of all the stocks that she owns right now, if you use that 20% number, are in bear markets. Well, a lot of them are down 35, 40%. So she keeps buying the dips, but that doesn't really make the difference in the end. But the bottom line is that we've seen this big sentiment correction is what I'm really talking about. It's not about ARK or those stocks. It's about the sentiment that has changed. And it's changed substantially, in my opinion, in a couple weeks' time. So now maybe the buy the dippers are out there, but it's buy the dip with maybe with a little bit of caution behind it. But I think some people have got hit pretty hard in some of these sell-offs that we've seen. And I've been talking about the illiquidity in the markets on the sell-offs and the machines running everything. So there's just a lot going on there. So let's talk just a little bit about economics coming this week. I said it's a light schedule. Nothing tomorrow. Tuesday, we got the trade balance, consumer credit. Maybe someone cares about those numbers. Consumer credit expected to be 29.9. We go to Wednesday, nothing really there. Thursday, we get to claims, 233, and the continuing claims at 1.95 last week. And so I've been talking about that 2 million number. We're under that now. So things look to be improving. I know the numbers missed on employment. I actually told you folks to watch out for a miss on those numbers, and they came in. And I think after an initial bid, I also told you, I went through, I know it was Thursday night maybe. I've been on the internet so much, I can't even tell you which broadcast it was now. But on Thursday night, I was telling you about if you get that pop and the higher opening, you want to fade it. That was one of the most famous trades we did on the trading floor and that's exactly what happened. We got a pop after the news came out, and you faded it. It was almost a perfect, I think it was R1 hit. I'll look at that in a minute. But then we just traded down almost to S3, which was a huge move because the volatility ranges right now, as I said, are quite big. And I'll talk about that more here as we go on. So since I already have the database, we can start with the database tonight like I usually do. I already have the results from there. So let's go ahead and take a look at some of those numbers and see what they're telling us. Nice, my camera turned on me. So at least it's smart enough to figure out where I'm at. Apologize for that. Okay, so let's zoom in on these numbers so you can see what happened. This is the intermediate database here. I've been talking, it was at 37% last week. And now it is turned over to 28.15. We had a lot of selling going on, which I also expected. We had 3,407 sells versus 475 buy signals. Brought us down to this 28.15. These are numbers that I talk about all the time. 28 and 22% are the numbers where typically the database will stabilize around these levels. So it's very possible that we've got the worst of the selling going on from that standpoint. But what it indicates is that there is no intermediate trends. There's 8 out of 10 stocks are trendless. And it's not just stocks. It's mutual funds, ETFs, even the bond funds are all mixed in there. But it's everything. It's 8 out of 10 symbols in a database of 16,359. So we cover a lot of symbols in this database. So we're at 28.15. If we flip over to the daily here, daily's now at 22.80. So there's that 20. It's amazing how these numbers pop up. I'll say 28. 22, it goes right to 22 here. We had 841 sells, 321 buys. So here we set at 22%. And we look at some of the sectors now. Right now, there's only one sector on a short-term basis that is long, and that's consumer cyclical right now. It's been long for 30 days. This is the shorter-term models. I do want to flip back to the weekly here for a minute, take a look at that. Look at the weekly. We still have 6 of the 12 sectors that are out there that we follow. We don't use the S&P sectors. We use a Reuters mapping. So we've got 50% of those. We've got 49% of the industry groups are still long, but 28% of the stocks. So as always, and I talk about this a lot, is that even though this database is narrowing down, it's really, it just says that it's not a lot of stocks that are holding the indexes together. So that makes it even more vulnerable. It doesn't take much for the few items that are moving to take this out. I ran into something I think I can show you fairly quickly here. I want to bring up the Portfolio Expert platform, and I've got the S&P 500, the blue line. I'll make this full screen, but I want to talk about some of the metrics here. The blue line is, we took all 500 stocks of the S&P and we put it into our modeling system. That's the blue line. The green line is the SPX. And so you can see it's way overperformed it, but we're trading each one of all 500 symbols we're trading individually. We also update them when McGraw-Hill changes the mix on the S&P, we change it. Right now, there's been, since 2000, there's 400, roughly, I think it's 451 changes in the database since 2000. So basically, the S&P 500 isn't even the same index. It's constantly rotating and stocks coming in and out. There are common symbols, but there's just been a lot of rotation. Things get in, they get pulled out. All of that stuff is going on all the time. So on a monthly basis, we update the constituent list on this. But one of the things I noticed, and the reason why I brought this up tonight as I go through the database, right now, if we look at what the percent long is right now, and I'm going to flop over here for a second because this is easier to see on screen. Let me get over to this. Bear with me a second. So you'll see the same number here, but here's the numbers. I'm going to attempt to zoom in so you can see this. And this, I thought this was very interesting. This is what I was just talking about. So I didn't have I was sort of right. So total stocks that have been put in this since over the last 21 years, 983 stocks, active 500, deactivated 483. So the index is turned over almost by 100%. So I've talked about this before, but because there's capitalization rating, there's actually some criteria, at least on the S&P, that tells you what type of stocks have to be in it. But the thing that I want to point out here, which caught my eye, is right now, even with everything that's went on, we're still almost 70% invested in the stocks in the S&P. So when I go over to we look at all the positions here, there's 282 symbols that actually have long positions. And some are winners, some are losers, all of that. But there's a lot of symbols in here that are still active. I was expecting to see this down, a little lower than what it is. And so that puts us right at, I go back to the summary page here, that puts us right at 3142. I've talked a lot about this, that a lot of our portfolios are around 40+% in cash. It's interesting that this is the S&P 500 constituent list, and we still have 31. There's only 31% in cash on the S&P. So there's still a lot of symbols inside of the S&P that's driving this index that is suggesting that there still is a possibility of some stability when it comes into the S&P. So I've been talking about, we got hit. Talking about like I said, I kind of really went off on this yield curve situation, which I still think is significant and is something to watch. And because the Fed knows they have to fix this. I guarantee you there were multiple conference calls over the weekend, even though you're not going to see any action. There's plenty that these folks need to talk about to keep these markets stable. So it's going to be interesting to see if they can just get the Fed presidents to run around and do little speeches and do interviews on TV, trying to jawbone this thing back to whatever, some kind of sensibility. But this information that I'm showing you here is interesting because there's still, like I said, 68% of invested in this strategy, even though we're down to almost half of the symbols being out. So it still managed to stay real invested. And this is, when you get a big subset of stocks in a portfolio like this, very few people can run technology that I've seen around in some hedge funds and some places can run this kind of constituent list and buy and sell and allocate and do everything that we do on 500 symbols. You can actually, I think, build as much as 1,500. We used to do the small, mid, and large cap. We had, the all cap S&P, which had all the constituents of MDY and IJR and then SPY in there. That was just way too much. But this is a large enough constituent list that you get a broad section of the market, and it's a section that a lot of people pay attention to. So I'm done. I thought that was interesting. It tells me there's a little more stability than what it feels like. The next several weeks as we come into year end, we'll see how the markets trade and see if we get further attrition. But I'm going to probably be bringing this strategy up several times as we go through the next several weeks. All right, so let's get into the indexes and start to just take a look at what's going on here. So I've been talking about this as a daily E-mini. Let's go through the expectations here, and there's a couple things. We traded just shy, just a few minutes ago, at the 45.62.50 has been the high in the evening. I'll blow this chart up here in a minute. But the R1 is 45.65.50. So we've basically printed an R1, and it's come off there about 10 handles. And we'll see if that holds up. It's early. We're almost 12 hours away from the U.S. opening, so it's a long time from now to see how this will set up. PPMs are trying to turn around. Let me make this full screen so we can go through this. So PPMs, one is turning up, but it's a minus 0.30, so that's trend mode. Anything under minus 2.5 is trend mode. What that tells you is 46.05. That's interesting, that number's still coming up. If you recall, a year ago, that was the target for the markets I had put out there, was 46.05. I think I did a video last November, and it said new Fibonacci targets revealed, and I got told how the market was going into bear market again, but we hit that number after all. Now what's happening is this number is coming down right now about 14 handles per day. So for today it's 605. Tomorrow it's going to be 90. You're going to be right around 95, 45, 95. And we'll see if a couple of days of stability here will start to flatten out this downward pressure. But one of the other things that I want to just draw in here so we can get a full perspective, just a lot going on for me to make sure you folks understand what's going on here. But this, I talk about these volatility bubbles. I'm just pointing out a few of them here. And typically when they happen, it's around at least some kind of bottoming pattern that sets up. So we have the angle of attack here coming down on the 10, and the 40 is still up, and the 21 is down, and probably will accelerate a little bit over the next couple of days. So what's happening here is this is a potential place for hesitation, and we missed out on trading down below that 44.94 number. I'll show you on a weekly chart when we go to the SPX. But this is probably going to set up some kind of stability here for a few days. I don't think we'll get above that 10-pair moving average unless this PPM here gets below 0.15. As long as it stays minus 0.15 or greater, the probabilities are fairly low that we're going to get over that 10-day moving average. Like I said, it's dropping 14 handles a day. That's going to put us closer to 91, 92, even if some of the downside bleeds off on this thing. So this bubble suggests that there's a potential for at least some stability here. It's not going to be full downside, every day is going to go down. And if you look at just the last several days, we basically have flatlined right through this volatility here. We really have been just going back and forth, and we've been getting these days where we get, one day up, one way down, and just a total sideways trading range. So look for possibility, some stability. The 45.87 is also going to be a point to watch. That's going to be your 40-period moving average. So we look at R165 getting up to 45.97 doesn't look realistic, but if you start to look at S1, S1's a retest basically of the lows on Friday. So we did print 44.94, I believe. Let me look at that number. Yeah, 44.92 was the low. S1 is 45.09, so we could end up with an R1, S1 today. We'll see if there's any kind of news and if the algos get involved or any of that stuff. They're trying to push this back up towards this 62 number again, but I'd watch for a rejection if you're day trading off of 65. Watch out, see if you get a 5-minute or 15-minute reversal around that number, and you probably play off of that reversal on an intraday chart if you get it. All right, let's go over to SPX. So SPX on Friday, we printed 46.08. R1 was 46.02. We got rejected off of there. We traded down. S3 was 44.95. The exact hit on S3, 45.95.75. The low was 44.95.12. So S3 was a great target. And if you watch that last few minutes of trade that we had on the close on Friday, I talked a bit about that on the live stream if you want to go back and watch it, where the close was. But the close was basically short covering. All the algos were selling all day, right? Basically from this 03, 05 print on the 46 handle, they were selling all day, just methodically knocking this thing down. At the end of the day, I guarantee you, all of those algos were hoping for a bunch of outside selling to come in, and it didn't show up. So they had to buy them back, and they bid it from 45.01 to 45.39. I believe it was 6 or 8 minutes without bringing it up. Roughly, it was a very sharp rebound, and it wasn't any new buying. It was just basically short covering from the algos, and they got caught. And that happens. You know, these guys don't always make money. They probably end up making some decent money, but it was a big give back on a lot of that. So I don't think, speculation, the Fed came in, supported. No, that's not what happened. It was all algos. I watched that market very closely on Friday. I was quite involved with it. So I know from my eyeballs being this far from the screen for multiple hours what was going on. I watched it very closely. So, and I shared that last hour with you folks. Anyway, so as we move on and we look at the expectations for the SPX, so R1 for tomorrow on Monday is 45.65. Similar numbers. That's a pretty decent rally on the cash from there. And then S1 45.11. The low was 44.95, and that number, that 44.95, I'm going to show you that comes up quite a bit. That comes up quite a bit in the analysis. There happens to be some key moving averages on a weekly basis, so that's going to be the number to watch for this week. All right, let's go over and let's set up this trade on the outside reversal real quick. So we're going to have to spend a bit more time here on the S&P before we can move on. So this is the weekly chart. I'm going to pull off the market. Well, let me just set the market grid first. So S1 45.08 on the weekly market grid, 45.68 on the R1, and then 46.01. And looks to me there's still upward movement here on the PPMs on a weekly. 0.18, 0.18 on PPM 1 and 2, they're both the same, and 0.42 on the underlying. So this is where this support is going to come in at, right at that 44.97 is the magic number. We didn't close under that on Friday. That would be pretty significant. So I want to take off the market grid for a second here. And what I want to show you, I talked about this, a couple of things happened. There was Fibonacci projections 47.67 that came out the week of November 5th. That's when these projections were issued. We traded up on the reversal to 47.43, so we fell just short of that, about 20 handles. We got an outside reversal and a key outside reversal, all-time new high, made an all-time new high, then took out the previous week's low. It actually took out, I believe, let me just look at this number here. Yeah, it took out not only the previous week, but the previous 3 weeks low. And then we closed on the bottom end of the range. So what we needed to happen, I talked about this last week, we needed a lower close on the week, and this confirms the reversal. And this is the criteria going forward for this week. Last week's height, 46.72. Last week's low, 44.95. So 2 things have to happen this week, okay? We have to not make a new high, so we can't trade above this level. And I'll bring up the market grid again here in a second. I did set it up. Around 46 handle is an R2 number. So we're looking at the potential here if we don't take out the high, 46.72. The low is 44.95. So we cannot take out the high of last week. We have to take out the low of last week, which is 44.95 or less on this week's action. If we do those two things, we do not have to close lower. That will continue to go to week number 3. So what's setting up right now is the potential for some weakness, some downward pressure into the next 2 weeks, possibly 3, putting us right at year end as we come into that. I know there's seasonal tendencies for Santa Claus rally, blah, blah, blah. Those things are just fun to talk about. If you traded on seasonals, you'd probably lose all your money in about 3 years if you're lucky. So the point is that what we're seeing here is that there is a reversal confirmed. This week doesn't have to close lower. It can actually close higher, just can't take out those metrics that I just talked about. So let me put the grid back on. We'll finally move on to the Nasdaq here. All right. Go to the daily, go to Nasdaq here. Nasdaq right now is up only 7 handles, 10, so it continues to be some weakness here. I've seen people talking about, Apple going to save the world. It's probably not from that standpoint. I won't cover that tonight. But the key number here, 15,883, high 15,752. We look at the daily grid. So far 15,752 is just below R1. So still looking R1, maybe R1, S1 is probably the numbers to look for. And as always, if you take out R1, you go to the next number, R2, you use those as pivots. So make sure you understand that. PPM's negative 40. That is 16,093. The 10-period moving average dropping about 70 handles per day. So it's going to be 60 roughly 500. That's 16,500. And then the next day it'll be below 16,000. So that should continue where the action that we're going to see in the next couple of days will come right into this average. And PPM 1 and 2 have rolled over. PPM 3 still has a little bit of upward slope to it. So that acts a little bit as some support in that area, 15,883. So we're trading just below that right now. Take a quick look at expectations for the weekly. The 10-period moving average, 15,773, closing trading last 15,722. So we're right around that number at the moment. Actually a little bit below it. We're probably going to get the extreme on the downside this week might be around 15,474. We look at the market grid. R1 15,894, S1 15,541. So that puts us pretty close to that 15.5 is going to be some pretty major support there. And like I said, so far, they're up 7 handles. They're underperforming. The RTY, which we'll go through the Russell next. I'll start with the Russell weekly on the cash. RTY right now is up 1.26, up 27 handles. So getting a decent bounce off of here. Weekly numbers here are really big from the standpoint of how this is formation. I just want to bring up and draw a couple things that is important to understand. I was talking about these little volatility bubbles. There's one here. That was back in April. We actually got a topping type bubble here. Right now, if you notice, we've got a clear channel being built by the market grid, which is being calculated off volatility. It's not some parallel lines that you and I drew on the chart. It's actually, this is coming out of the market grid. And when we get these slopes, you'll see even I'm drawing in over here, this was another one of these channels that grew. We typically will stay in that channel, and we're looking at all the PPMs in a negative mode and in trend mode on a weekly basis. So this is an intermediate trend down. Hopefully they'll stabilize a little bit, but there's nothing really positive to look at when you're looking at the Russell at the moment. Let's just go to the spread very quickly. We're seeing a rebound in the spread here. Get the right chart up. We're seeing a little bit of rebound. Looks like it's going to continue. Now we're going to have resistance along this level on this spread up here. So we'll watch that, see if they can get some bottoming, as I've been talking about for a while. I feel like for us to get any kind of sustainable rally, certainly above that 47 handle that we printed a number of weeks ago, you've got to have participation of these small cap stocks. And when you see the potential projections on yields, it's hard to believe. Talk about flipping the script. There's some potential for yields to continue to decline here, which all of a sudden tells you just what I've been saying in the opening comments, that all of the metrics that were scaring the market about inflation, we're seeing an adjustment here. And the yield curve, which I'll touch on here, I've done so much on the yield curve, I don't think I need to say anything else. I would just tell you, go back and watch Friday's video I did intraday, the special report. Go back and watch that, and that will get you all the information and more. I think in the beginning of that stream, I went into a lot of depth on what I think this means. But for right now, these lower rates aren't going to help this market that much. So this is going to be a bit of an issue, and maybe we'll just see. I think what we're seeing now is, I said this on Friday, as traders and market participants are looking for cheap. And I always have I have a million little cliches, but one of them is cheap doesn't make it good. The fact that a stock is down doesn't make it good. Certainly, there's a lot of people out there that buy the dippers and, oh, it's down to here and this is a great company because they know something about the future, which you don't. Is that, cheap doesn't make it good. I have to find this thing so I can put it on screen for you folks. I know it's on my computer. I just haven't had a chance to dig it out. But there's a cartoon of a guy standing on the corner. He's panhandling. He's got a hat out trying to collect some money. And he's got a sign on his chest that said, bought low, sold lower. And that's what you want. That's what happens when you get into some of this stuff, when you have these very negative trends and you have an attitude or some kind of thing that, this is going to be a good company for a while. It doesn't always work out that way. And in fact, I would be willing to say that probably 60% of all the IPOs that happened in 2020, 3 to 5 years might not even be listed anymore. I've been through a lot of these cycles, and probably my favorite one, not even going to .com, was going back to '92 when I was on a Pacific Options Exchange, and there was a biotech boom, and they didn't care what it was. If it said it was a biotech, they would just run them up and go crazy, and all of those collapsed, and there was never any value in any of those stocks. And we have a lot of junk out there on the street right now, a ton of them. We're probably looking at something similar, just to go on a little mini rant here, similar to the .com, where everything was going on. I was talking to somebody the other day that's involved in commercial real estate, and they were saying anybody wants money, you can get money right now. They don't even care if the project, what the numbers look like, pretty much. You want to do the project, fine, there's money. The perception in the markets right now is there is no risk in anything. And whether that's the case or not, we'll see. But those are the kind of market sentiment and ideas that come out of places where you get in trouble and the economy gets in trouble. And so anyway, so let's move on. Mini rant. So since I'm already on screen here, so this is the plan for the rest. I'm going for the rest of this show. I'm going to do the 10-year. We're going to look at the yield curve. We'll look at a couple other items there in the interest rate area. We're going to hit on crude oil. Then we're going to go to gold, and then we'll off to Bitcoin and call it quits. So I think I can get through this whole thing probably in, I'm going to give myself 20 minutes or less. I'm going to try to 15. So maybe I can get through each one of these markets in 5 minutes, and that would be awesome. And we can all get on. I'm still ready for dinner for tonight. So let's go ahead and start to take a look at some things here. Yeah, so we'll start with this weekly chart of the 10-year. Okay, let's talk about the 10-year here. And we got down to almost the RTX level. Let me get that on screen here. This is a weekly chart, but look at what's going on here with the PPMs. Minus 0.76 PPM1. PPM2 is flat. PPM3 is negative. And there is a cap on this market at around probably 149, 1.49. And that's a long ways from here. That's light years from where we're trading right now. On the downside for this week, we're looking at 1.98, 1.29, I'll get this right, 1.29, and S2 is 1.248, basically 1.25%. That's a long ways from the disaster we were talking about not that long ago, printing over 175 and going to the 200-week moving average at 1.87. You know, all of that talk, it's all gone. And that's what I was talking about 2 weeks ago, is that all of that changed. It got flipped on a script on that Friday when this decline started and all of the craziness that was going on out there and generated by, you know, a new variant, right? That was the dialogue. So I'm going to go a little conspiracy theory on you just for a second. Wasn't it convenient in the timing of that event that one case hit the United States and they tanked everything? They did crude oil, the interest rates turned, the stock market turned, everything went down, right? So I just think it's very, very interesting, the timing and how convenient that was right after they are releasing, you know, we'll talk about crude here in a minute, but releasing all of the, you know, strategic reserve and all of that, you know, they, 3-day supply, but it actually lasts more than that. And they actually didn't release it. They gave it to traders as a loan, and the traders can return or replenish. That's how it's an interesting deal. I think it's kind of genius, whoever came up with that. I'm sure it wasn't Brandon, but somebody really genius came up with this concept and idea. So they were able to basically do something, but not really do something. I'm on crude, I'm sorry. But all of this has to do with what happened in interest rates. Everything that we're seeing is exactly planned and going as planned at the moment. So let's go ahead and take a look at the yield curve, because that's been a big topic for me. I put in something interesting here. I did the 13-week versus the 10. Okay, so this is interesting to take a quick look at. is going up and steepening, which is not what you want. Okay, that means that the short end is going up faster than the long end. And it's interesting because this is a chart going back to 2008. So you can get a very good perspective here from this standpoint. If we go over to this is the 1030 spread, it's just continuing to collapse. So it's happening on the yield curve. Typically in this, I know I went through so much of this, but it's important to keep in mind what's happening is the back end of the curve is actually rolling over. And even in the middle, what's happening is flattening completely. You could get where there's no benefit to own a 30-year or a 10-year security. Right now, the 1030, if you want to pay up for 30-year bond, you're going to get 0.33 of an edge for putting your money out for 30 years. Now, I realize that these instruments are traded, that people aren't buying them for 30 years, but what the marketplace is telling you is that there's absolutely, no benefit to lend your money long. And that's the whole scenario with the banks, right? They borrow money short on the short end and they lend long out to consumers. Well, there's a bunch of numbers. I was playing in Fred, the Fed's database earlier tonight. I wasn't able to get all the metrics together that I wanted to have. But basically, the savings rates, we've seen it, they've just went through the ceiling. They've doubled, the savings rates. And the loans versus the savings or the deposits are, they're not lending any money, but they are lending money. So it's a really interesting conundrum that we find this in. And I think the Fed is ultimately screwed no matter what they do. And I went through those details, so I'm not going to go on another rant on that tonight. Watch Thursday night's video, but probably Friday's day, the opening first half hour or so is probably worth watching if you want to hear more on that. All right, we'll continue on. Get to the right chart here. So futures, E-minis trading 56, so we're still up 19 handles, 0.42. A little bit of a bid still hanging in out there. Okay, so let's go to crude oil next. I think this is a weekly crude, and I mean the turnaround. If you go back and watch some videos I did 3-4 weeks ago, I saw the decline coming, thought it would hold around the 21. That would have been around 72 to 69. You might remember those numbers. Well, we printed down as far last week as 62.43. And well, we're likely to set up here. I just want to get my little pen out. Let me go full screen. I want to draw on a couple things here. So I'm talking about these volatility bubbles that usually set up some kind of low. We got one here. There's a little bit of one here, but we're probably setting up something over here too. So markets are going to stay, and I'll bring up the grid here in a second, but markets are going to stay within this range. Probably seeing the worst. We traded down almost to the 200-week moving average. That's at 59.79, so we're like $3 off of that. So my expectations are we are going to stabilize here, and we'll see what's next on this one, because I think because of this breakdown and trading all the way back to the 200-week average is really set up a large consolidation. Probably, what is this? This is early December. We could be still talking about this consolidation at least into first couple of weeks of the new year and maybe beyond. Okay, so that's going to be very interesting from that standpoint. But when we see these volatility spikes, here's another one over here, a bit of a one here. They just always set up some consolidation, some stability, all that kind of stuff. So those are things that That's what I'm looking for right now from that standpoint. And we're probably going to be in a what I call a box pattern. Let me remove some of this real quick. Is that I've got to do, you got to bear with me for a second because I've got to take something off so I can draw this in. So this market grid is going to stay somewhat in this range for the next couple of weeks. The 10-period moving average is going to decline down in here. The 21 is likely just to flatten out. So we'll start to get some crossovers of the slower moving averages. And when you get that, once again, especially in a pattern like this, just sets up pretty major bottom here as far as I'm concerned. So as far as a full out collapse and we're going to $40, no, that's not happening. In fact, the range is going to be probably, we'll call it 62 to 72 is going to be the basic range to expect here. Now we go just real quick, and I believe I showed this the other day, but I'm just going to flip to a monthly chart. What's interesting about this, the PPM2 is just screaming, and it's the lowest average in the pattern. So what we should get here is in the next 2 weeks, we should see the 21 rise above the 40. That's going to set the bottom as well. Right now, that number is 53.47, and it's going up $2 a week. So we'll be up in that 58.60 handle in the next month's time, but likely we're just going to stay in this range for as far as the market grid goes for crude oil this month. Let me put it on screen so if you want to take those numbers down, you can see them easy enough. But those numbers here, S1 62.95. So far the low's been 62.43, high 69.49, and we're looking at R1 69.41. So we've printed an R1 S1 right now. And if I had to make a bet, we'll probably take out R1 before we'll take out the S1, just on that. So we're move probably in between R1, R2 would be the best you could expect. But this PPM 2 that is screaming here is telling you that the underlying strength is and support will be in this market. It's going to be several weeks. Sideways is all it takes to keep this thing rolling in a very strong way. Okay. I might as well just start off, since I have this monthly chart. We're going to go to gold here. And I've been talking about this gold chart. Still like it. Monthly. PPM1's turning up. It's actually in trend mode. That number is at 1794. This is monthly, so close over 1794. I still think 1800 is an important number. We go across the board. Let's go to the weekly. Just take a look at this. Weekly chart just hovering all three averages. I know I've been like this for 3 weeks now. 1799, 1797, 1799. That's 10 period, 21, and the 40. And the 200-week moving average is way down at 16 handle. I think we're just going to stay in this range here. R1, 1801. S1, probably S2 is 60. We've already printed 1762. Probably S2 is could print down to 1745, 1750, 1801, possibility of 1815. We'll see. We get into some of the analysis as we go in the next several days. We'll be able to get through that. Okay. Bitcoin, it is time. So I talked about this last week. This does not reflect the actual low. This I have to figure out. This is kind of kind of lame. I think I need, because I think we traded 41, and this is showing right now the weekly low 47, which I know is not right. We did spike down to 41. I saw on some other stuff. Yeah, yeah. That's the problem with Bitcoin, is if you're not awake when one of those spikes happen, you don't get to do it, and yeah, you don't get to do it if you're not awake. I guess you could put orders in, but who does that? I don't think that happens. So, but what we're seeing here is the PPM1 is still 0.84. It's turning down. There was a lot. I was reasonably optimistic last week of holding this 10-pair moving average. Now we're down to the 21 in this pattern, and we're still got a slope of 1.37, 1.12. You folks know the drill here. This chart updates tonight at midnight, like in a couple hours here, midnight Eastern time. And so I would lock this thing down, 58 handle on the upside, probably looking, here at 48, 49 on the downside. I'm going to flip over to a daily. We'll get a little better look here. Daily's right like through, it's about to get an STX buy signal, which would suggest possibility of coming back into the range of 50. We'll call it a minimum 52.8, 54 would be a range we'd get. But PPMs are rolling over now. Major resistance 55.6, coming down about, let me try to get a number on this, about 1,000. So 54 again is going to be the extreme. I could see a possible trade up to around 52. I'm going to show you an hourly graph here, which I think was setting up pretty good here. This is a gap down that shows up on this chart, and I said maybe I should bring up the trading view to get a better shot at this. But I've got some other metrics here. We've got some cycles that hit. We had a cycle hit right at these lows here when they were showing up here on this chart, and we got some more cycles coming in. Looks to me this 40 period moving average would be about all you expect if you can hold these lows here. Probably get a breakout over 40, 49, 49.5. You got resistance again at 50,600, and then the potential of running 52, 54 would be the max. But probably that spike low will end up to be a significant low at that 41 handle. Yeah, as far as, let me come back on screen here and we'll finish up. Yeah, so as far as Bitcoin going with the rest of the markets, who knows what was that about? What was the capitulation that happened there? Maybe those of you that are much deeper into staying up on that know that. Post something in the comments if you'd like, if you feel like you've got some knowledge on that. I don't follow Bitcoin at that level, just from a technical viewpoint, and that's pretty much it. So I haven't done a lot of reading to see if any speculation of who, what, when was selling on this thing. So I don't know that. But anyway, we're starting off another week. I know I do all this stuff at the end. I try not to be too aggressive, but we do have our live trading room that happens Monday, Wednesday, Thursday. Get to hang out with me for 9 hours every week, and we get to do a lot of education. We're getting ready to release the PPMs. Unfortunately, one of our team members is down with COVID at the moment. He's doing fine, but he's out of the game, and so I'm hoping that he can get back in the game this week, and so we'll get some of these things done. But we're going to release all my indicators to the first 100 players. I still think there's about 25 or 30 seats. So join us. You can go to kendallreport.com/trade. You can go there and you can find out more about that. And don't forget about our portfolio products as well. There's a lot of stuff that we're doing for the retail community. Had a really good Zoom meeting on Saturday with some folks that are in the live trading room. That was fun. Just we kind of hung out for a couple hours just chatting. We ended up getting way off topic, but you know, we're really building a lot of folks in this community that want to be part of this and get some of my legacy knowledge that I share with you folks on YouTube, and I touch on little bits and pieces. And so it's nice to go on a big riff on maybe on PPMs and market setups and all that kind of stuff. So anyway, have a good day trading. Be careful out there. Still plenty of volatility. And you know, I'll see you tomorrow night, and I'll see those of you in the trading room at 1 p.m. Eastern time tomorrow. Have a great evening, everyone. Thanks for watching. Appreciate it. Remember to subscribe, click the bell, and share these videos. Thanks again.